Millions of retail investors are checking their portfolios right now, seeing green and packing their bags for a long summer vacation. But while the public relaxes, institutional trading floors are quietly setting a trap. Market history reveals a very clear, mechanical pattern. The spring months regularly hand out comfortable, low-effort gains to everyday investors. Then, as the heat sets in around July, those same gains are violently pulled back. Right now, 3 massively popular stocks are flashing severe structural warning signs. We are looking at Dexcom, then Colgate-Palmolive, and finally Oracle. Behind the public hype, the smart money is already analyzing the cracks and moving toward the exits. Holding these 3 specific stocks blindly into the upcoming season turns your hard-earned gains into immediate liabilities. Sell in May and go away is treated like an old Wall Street myth. In reality, it describes a guaranteed mechanical event. When major fund managers leave their desks for the season, the overall volume of trading drops significantly. This chart shows exactly why that matters. In a normal, high-volume market, bad news creates a small dip. But look what happens when trading volume abruptly drops off. Without enough active buyers to absorb the shock, a rising trendline snaps downward into a vertical cliff. This creates a dangerous asymmetric disconnect. Retail buyers look at a stock's strong performance over the past 6 months and assume the trajectory is permanent. Institutional algorithms operate differently. They ignore the past and strictly price in the risks of the next 6 months. Summer liquidity is a mirage. It uses a retail investor's own backward-looking optimism against them, leaving them exposed right as the market thins out. Let's apply this to our first stock, Dexcom. For years, this company dominated the continuous glucose monitoring sector. It was viewed as an untouchable growth stock, riding a massive global healthcare trend. But look at this area chart representing the total addressable market for diabetes tech. As the explosive adoption of GLP-1 weight loss drugs expands into the space, Dexcom's total market share is being aggressively squeezed. The underlying math of their customer base is shrinking. Wall Street analysts track this closely. As we overlay the valuation multiplier on the shrinking market, you can see the institutional response in real time. They are revising their terminal value models, their estimates of the company's long-term worth. Dexcom's narrative is shifting from guaranteed expansion to a defensive battle for territory. Maintaining a premium growth multiple on a stock that is actively fighting a structural macro shift is mathematically destined to fail. Next is Colgate-Palmolive. When investors get nervous, they flock to consumer staples. People always buy toothpaste. It feels like a defensive shield, allowing you to sleep well at night while the rest of the market shakes. That perceived safety is a trap. This line graph exposes the company's hidden weakness. The top line shows product prices rising sharply, which keeps revenue looking strong. But the bottom line, actual unit volume, is stalling out. They aren't selling more products, they are just charging more for them. Consumers have a hard inflation ceiling. Watch this third metric. As everyday buyers hit their spending limits, they abandon the brand name, causing generic private labels to spike upward and eat directly into Colgate's market share. The moment a consumer staple can no longer outrun its rising costs with price hikes, the illusion of safety vanishes. Institutions instantly dump these overvalued safe havens, turning your defensive shield into an anchor. Finally, we have Oracle. Driven entirely by the artificial intelligence hype cycle, Oracle has seen a massive resurgence, pushing its valuation multiples to extreme elevated highs. The problem lies in the mechanics of the AI infrastructure game. It is a capital expenditure war. Oracle is forced to spend massive, continuous amounts of cash just to compete against hyperscale tech giants who have virtually infinite reserves. To justify its current stock price, the market has priced Oracle for absolute perfection. They are assuming a flawless execution of their cloud migration strategy, leaving zero margin for error in an incredibly expensive environment. Corporate AI spending will inevitably shift from speculative building to demanding actual return on investment. When that happens, highly leveraged infrastructure stocks face a brutal valuation reset. Summer corrections are violent because of a massive asymmetry in information. Institutions spend millions acquiring alternative data. They track satellite supply chain logistics and run predictive churn models weeks before earnings reports are ever made public. They use this early data to engage in distribution selling. This is a process where large funds spend weeks quietly offloading their shares in small blocks. They sell steadily while everyday retail investors are still buying based on delayed positive news headlines. This is the dark truth of the market. Smart money requires the blind optimism of retail buyers to serve as exit liquidity. Without an unaware buyer taking the other side of the trade, a billionaire cannot escape a multi-billion-dollar position without crashing the price. Surviving this environment requires 3 strict rules. First, audit your thesis and remove any emotional attachment to past gains. Second, track declining trading volume to spot when institutional support is fading. And third, prioritize cash liquidity over brand loyalty. Summer is the ultimate test of investor discipline. The macro data softens, the trading desks clear out, and the institutions quietly rotate their positioning while nobody is watching. You have a stark choice right now. You can ignore the glaring warning signs in these specific stocks and hope for the best, or you can proactively take control of your capital, lock in your gains, and wait to buy back in at a massive discount later this year. The market never subsidizes hesitation. Trade the reality, not the hype. If you want to keep your capital on the right side of the trade, hit that subscribe button. Stay smart, stay disciplined, and we'll see you in the next video.